Most technical analysis is garbage. After 15 years of day trading, I can prove it. I'm ranking every tool from God tier to get it off your charts, starting with the absolute best. Price action is S tier. No indicators, no lag, just reading what price is actually doing. Engulfing candle breaking structure, trend change happening right now. Inside bar after a big move, market taking a breath before continuing. That's as clear as signals get. No lagging indicators, no complicated formulas, just the market showing you exactly what's happening. The best traders in the world use this because everything else is just a derivative of price. But before you think all tools are this good, moon phases, F tier. Yes, people actually trade based on whether the moon is full or not. The theory goes like this. Full moons affect human emotions, so markets go crazy. I'm not making this up. There are actual moon phase indicators on TradingView. I tracked this for 6 months. You know what I found? It works exactly 50% of the time. You know what else works 50% of the time? Flipping a coin. If you're checking moon cycles for trading signals, maybe try astrology next. Now let's jump to something that actually works. Support and resistance, B tier. The foundation every trader starts with. And why does it work? Because everyone sees the same levels. When price bounced at $50 3 times, every trader on earth has that level marked. It becomes important because we all agree it's important. Round numbers, previous highs and lows, areas of consolidation, these create psychological barriers. Price respects them because humans respect them. B tier, reliable but basic. It works, but there's something even better coming that shows you why these levels exist. Speaking of things that don't work properly, Elliott wave theory, D tier. The idea is markets move in waves, 5 up, 3 down, rinse, and repeat. Sounds logical. Here's the problem. If I show the same chart to 5 Elliott wave traders, I will probably get 5 completely different wave counts. One will say we're in wave 3, another might say wave 5, and one guy will insist we're still in a correction from 2010. The problem is that you can only find waves perfectly after they're done. By then, the trading opportunity is gone. D tier. Too subjective to be reliable. Now let me show you the evolution of support and resistance. Supply and demand zones. A tier. This is support and resistance on steroids. Instead of thin lines, you're looking at zones where big players actually put their money. See that aggressive move up from here? That's not random. That's where institutions loaded up millions of shares. When price comes back to that zone, those unfilled institutional orders get triggered again. Support and resistance shows you where price reacted. Supply and demand shows you why. It's like seeing the cause instead of just the effect. Look for zones where price moved away aggressively. The stronger the move away, the more institutional interest is there. A tier. This is what professionals actually use. Now for something completely useless. Gann angles, F tier. Drawing diagonal lines at specific angles, like 45 degrees, because supposedly price and time move in perfect harmony. This was created in the 1920s. The theory is that markets move in geometric patterns. The reality, markets don't care about your geometry. That's not analysis. That's hoping one of your lines gets lucky. F tier. Leave this in the history books. Now let's look at the most misunderstood indicator, relative strength index. C tier. This shows momentum on a scale from 0 to 100. Here's what everyone does wrong. They see the indicator hit 70 and immediately sell because it's overbought. Then they watch it stay above 70 for 2 days while price keeps rising. In strong trends, overbought isn't a sell signal, it's confirmation of strength. The only RSI signal worth watching. Divergence. When price makes a new high, but RSI makes a lower high, that's momentum dying. That actually means something. C tier. One useful feature doesn't make it great. Now for something that will blow your mind. Volume profile. S tier. This shows where all the trading happened at each price level. See this huge volume node? That's where millions of shares changed hands. That's not a random level. That's where institutions build positions. Now you know exactly why price keeps reacting there. Regular volume shows when trading happened. Volume profile shows where. It's like having X-ray vision into what really matters. Those high volume nodes become future support and resistance. Low volume areas get sliced through quickly. This is the difference between guessing and knowing. S tier, professional grade information. Now back to the disasters. Harmonic patterns, D tier, bat patterns, butterfly patterns, crab patterns. It's literally a zoo on your chart. Each pattern needs exact measurements. The bat needs an 88% retracement. The butterfly needs 127%. And if you're off by even a little, your butterfly just became a very expensive mistake. I tried this for 3 weeks. Spent more time measuring than trading. The few times I found the perfect pattern, it failed. You're basically looking for shapes in clouds and betting money on them. D tier, overly complicated for mediocre results. Now something that actually helps. Moving averages, B tier. Just lines showing the average price over a certain period. Here's the thing. The 20, 50, and 200 moving averages are watched by everyone from beginners to billion-dollar funds. When the 50 crosses above the 200, called a golden cross, institutional programs literally start preparing buying. Price above a rising moving average, uptrend. Below a falling one, downtrend. It's not magic, but it works because everyone uses the same numbers. B tier, simple, effective, reliable. And now for something that should be deleted immediately. Parabolic SAR, F tier. Those dots that appear above and below price. In theory, dots below mean buy, dots above mean sell. In reality, the dots flip constantly. You'll get whipsawed into bankruptcy. It's like taking trading advice from someone with severe mood swings. A guaranteed path to an empty account. F tier, deleted from your charts. Here's what you should be watching instead. Market structure, A tier. This is simply reading highs and lows to understand the trend. Higher highs and higher lows, bullish structure, only take longs. Lower highs and lower lows, bearish structure, only take shorts. It's that simple and that powerful. Break of structure tells you the trend is continuing. That new high in an uptrend, green light to buy pullbacks. Change of character warns you everything is about to flip. That first lower low after months of uptrend. Get out or flip short. Master this one concept and you'll never fight the trend again. You'll never buy into a downtrend because it looks oversold. You'll never short into an uptrend because it has to pull back. A tier, the foundation of price movement. Now let's address the elephant in the room. Fibonacci, C tier. Those percentage levels everyone draws, 38, 50, 61%. Here's the truth. It's not magical, but millions of traders use these exact levels, which makes them work through self-fulfilling prophecy. When 1 million people have buy orders at 61%, price tends to bounce there. The 50% level works best, not because of golden ratios in nature, but because humans like halfway points. It's basic psychology, C tier, useful for confirmation and confluence, dangerous alone. Now for something institutions actually care about. Volume weighted average price, B tier. This shows the average price weighted by volume. Basically the fair price for the day. Why should you care? Because institutional traders are literally graded on whether they beat VWAP. Buy below it. Good job. Buy above it. You're overpaying. This creates natural support and resistance as institutions defend their average prices. Price above VWAP. Buyers in control. Below. Sellers dominating. It's that simple. B tier. One of the few indicators banks actually use. Now, this next one will trigger some people. Trend lines. D tier. I know this is controversial. Here's why they don't work. Give 10 traders the same chart, and you get 10 different trend lines. Use wicks or bodies. Start from which low. Move it 1 pixel, and everything changes. It's completely subjective. You're drawing diagonal lines, hoping price respects them. The only trend lines that matter are horizontal ones, and those are just support and resistance with extra steps. D tier for me. Your diagonal lines are just wishful thinking. Next is volume indicator, A tier, the number of shares or contracts traded. This is the truth detector of trading. Price can lie, fake breakouts happen daily, but volume never lies. Big move with big volume, that's real. Big move with tiny volume, that's a trap. When you see a massive volume spike, that's not retail traders with their 100 shares. That's institutional money moving the market. No volume means no conviction. A tier, the one thing that can't be faked. Speaking of misleading indicators, Heikin Ashi, C tier. These special candles smooth out price action and make trends look perfect. The problem, they don't show real prices. That smooth green candle, it's hiding a massive wick that would have stopped you out. It's like using a beauty filter on your trading. Looks great, but isn't reality. Good for seeing the overall trend direction. Terrible for actual entries and exits. You need real prices for real trades. C tier, training wheels for trend identification. Here's something surprisingly useful. Pivot points. B tier. Mathematical levels calculated from yesterday's high, low, and close. Sounds arbitrary, I know, but here's why it works. Every algorithm uses these same calculations. When thousands of trading bots respect the same levels, those levels become real. It's standardized support and resistance. These aren't random levels. Institutional algorithms are programmed with them. R1, S1, central pivot. Free levels that everyone sees. So B tier, free levels that actually matter. Time for another disappointment. MACD, C tier. 2 lines crossing with histogram bars below. Here's the truth. It's just the difference between the 12 and 26 moving average. All those crossovers everyone trades, they're so delayed, you'll enter after half the move is over. The only useful part is histogram divergence, when the bars get smaller while price goes higher. C tier for me, complicated way to show simple information. Now for something actually sophisticated. Market profile, A tier. This shows where price spent time, not just where it went. See that fat node in the middle? That's where 70% of trading happened, the value area. The thin parts, price got rejected quickly. This creates a bell curve that shows you market structure. Point of control, the fattest point, acts like a magnet. Price keeps getting pulled back there. It's showing you where the most business was conducted. A tier, understanding value versus price is game-changing. Now back to basic. Bollinger Bands, C tier. Bands that expand and contract around price. Everyone thinks touching the upper band means sell, lower band means buy. Then they short into a strong trend and get destroyed. The bands show volatility, not direction. The only reliable signal when bands squeeze tight, a big move is coming. but it doesn't tell you which way. You still need other analysis. C tier, one good signal isn't enough. Now for the risk management hero, average true range. B tier shows how far price typically moves per candle. This won't tell you direction, but it'll save your account. If ATR is 50 points and you put your stop loss 10 points away, you're basically donating money to the market. Your stops should adapt to volatility. Bigger ATR means smaller position. Smaller ATR means you can trade larger. It makes risk management mathematical instead of emotional. B tier, boring but essential. And now, the ultimate tool, footprint charts. S tier, this is order flow on steroids. Imagine splitting a regular candle open and seeing every trade inside it. Normal candles just show you the end result, red or green. Footprint charts show you the entire fight that happened inside. You literally see how many buyers versus sellers traded at each price level, displayed as numbers inside the candle. Why is this huge? Because a candle might close red, but if you see tons of buying at the bottom, you know buyers are stepping in hard. It's like seeing the future before it happens. This is what the professionals on Wall Street are watching, the actual orders flowing through the market, not just the final candle color. S tier, the most powerful tool retail traders can access. You just saved yourself years of losing money on useless technical analysis concepts. You've got the cheat sheet for day trading success. And if you're ready to fit this into a full A to Z trading system, that's what our academy is for. Link is in the description.